Welcome to Talking Markets with Franklin Templeton. We're here today with ClearBridge Investments Head of Economic and Market Strategy, Jeff Schulze. ClearBridge is a specialist investment manager of Franklin Templeton, and Jeff is the architect of the Anatomy of a Recession program, a program designed to provide you with thoughtful perspective on the state of the U.S. economy. Jeff, with recession fears growing, I wanted to start off by checking in on the health of the U.S. economy. Did the ClearBridge Recession Risk Dashboard have any changes at the conclusion of April?
Really excited to be here. Thanks for having me. And while it's too soon for the hard data indicators to show trade-related weakness, profit margins was seeing headwinds even before Liberation Day tariff announcements happened earlier last month. It worsened to a cautionary yellow from a green expansion, but the overall dashboard still remains in expansionary green territory, and there weren't any other indicator changes that month.
So profit margins changed to yellow. Does that concern you maybe more than usual?
The deterioration in profit margins reflects events that unfolded prior to the escalation of the trade war. So inflation, essentially pricing power of corporations, it's cooled a lot more rapidly than wages in other key inputs from a cost perspective, and that's ultimately crimped profits. And it's driven profit margins down from record levels, which is the reason for the signal change. Now, in the absence of a trade war, this dynamic would be much less concerning to me. But today you have the prospect of additional strain on margins in the coming months as higher tariffs are going to come into the cost structure. So the reason why this is worrying is that as margins contract and profits erode, corporate management teams often are forced to lay off workers, and that starts or even amplifies a recessionary feedback loop as consumers pull back given their loss of income. So yeah, I'm a little bit more concerned than usual just because we have this force that's likely going to weigh on profit margins further as we look ahead in the coming months.
Okay, let's talk about the labor market given weaker profit margins. The April jobs report was out last week. It looked to me like a solid report, and markets seemed to respond in a positive way. What's your view?
It was a rock solid jobs report. That's exactly what you want to see. Non-farm payrolls for April was 177,000. Yes, you had some revisions downward for the prior 2 months, but the 3-month average job creation right now is still at a very healthy 155,000. Unemployment rate didn't change. You even saw a little bit of a tick up of the labor force participation rate. It was a good print, and you really can't poke a lot of holes in it. And I think the key takeaway here for the listeners is that the April's jobs report shows that the labor market was on a solid foundation as the trade war tensions became much more disruptive early last month. And the data for this release was actually collected the week following the Liberation Day tariff announcements. So it can't be completely dismissed because it does reflect some elevated uncertainty because of the increase of tariffs. But I think also more importantly, it's a little bit too soon to expect the substantial fallout to emerge quite yet. So this may be the calm before the storm. We're going to be looking at the jobs report very closely in the coming months to see if it does kick down into a lower tier. But the good news is that the labor market was pretty solid as we were going into this period of uncertainty. So that's a really positive dynamic. And it's a key reason why our base case right now continues to be that we are not going to have a recession. We think GDP growth is going to be around 0.5% this year. And the labor market strength that we're seeing is a key reason for that.
Are there any other important labor market data points that you're watching?
Initial jobless claims are maybe the single most important economic indicator to watch. If I was on a desert island and I only had one piece of data to monitor for the economy, it would be initial jobless claims. Top 3 indicator in the Recession Risk Dashboard. We like to refer to it as our canary in the coal mine. And claims have been holding up extremely well in the weeks following the Liberation Day tariff announcements. And although the latest release saw a jump of claims by 18,000 up to 241,000, when you look beneath the surface, that jump was from New York, where some school workers were allowed to claim jobless benefits during the spring break. And you see this every year when we're likely going to see claims jump back lower as we get this week's release. So the 4-week moving average is 266,000. Very healthy number. It's been around these levels for the last couple of months. If we start to see this increase, we're going to get a little bit more concerned. But at this point, it looks like employers are not letting go of their workforce because of the uncertainty that we have with tariffs.
Okay, Jeff, another important indicator on the ClearBridge Recession Risk Dashboard is credit spreads. You mentioned on last month's podcast that we could see that indicator change this month. Any update on credit spreads?
Well, this is, again, another top 3 indicator. So this is one that you want to have as green along with initial claims. And when we had done the podcast, credit spreads were blowing out. And we look at high yield spreads in particular. And credit spreads had gone from around 315 basis points in late March to about 450 basis points on April 7th. So that's a pretty big move in a short period of time. But since we've gotten some positive developments on the trade front and we've gotten some more resilient economic activity, that has dropped down and done a round trip back to 350 basis points. So it's a little higher than where we were in late March. But for some perspective, if you look at recessionary periods, high yield spreads usually get to about 800 or 900 basis points. And at 350, we're well beneath those levels. So it appears that fixed income investors aren't really concerned about a recession materializing in the U.S. economy.
Okay. GDP in the U.S. was negative in Q1. Does that mean we're actually already in a recession?
It doesn't. I know a lot of people think that it's 2 negative quarters of GDP as a recession, but there's a lot more that goes into that calculation by the NBER. But when you look at the data specifically, it was distorted because of a couple of factors. First off, you had the largest ever drag on growth from net exports as people were front loading things before those tariffs. Net exports actually shaved 4.8% off of this quarter's GDP reading. When you have a lot more imports than exports, that's actually a negative to the GDP calculation. So that was one important driver of that negative number. You also had some weather-related distortions to consumption. Coldest January that you had since 1988 in the U.S. You had the worst flu season since 2010. That weighed on consumption. And as the weather warms up, consumption should be more robust. And then also you had a normalization of aircraft production and defense spending this quarter compared to quarters prior. So when you put this all together, the GDP print is being pushed down artificially. A way to kind of get a good gauge of the real trajectory of the economy is to look at real final sales to private domestic purchasers. I know that's a mouthful, but it's a similar concept to core CPI. This is a core GDP concept. It excludes things like trade. So those imports, exports that we talked about are not in that calculation. It takes out inventories, and it also takes out government spending. And this core GDP reading came in at 3%, which is right in line with what we've seen over the last couple of years. So coming back to what we said about the labor market's on a good foundation coming into this period of uncertainty. So was GDP when you look at it from a core measure also.
The title of this month's Anatomy of a Recession commentary is vibecession or recession. What does that mean?
About whether the hard data, so the actual economic releases that you see, will ultimately follow the soft survey data that individuals answer. How do they feel from a consumer or a business perspective? And this primarily stems from what occurred in 2022 when the soft data weakened in the wake of the Russian invasion of the Ukraine, the regional bank crisis, elevated inflation, but the hard data largely held up. So this period came to be known as the vibecession because even though many Americans didn't feel great about the health of the economy, they continued to spend in a very healthy manner because of a strong labor market, prior fiscal support, so the stimmy checks, and then residual pandemic savings. So if you think about where we are today, maybe it's a little bit of a different situation than where we were back in 2022, but we just won't know until we look back and we can see what the hard data actually does. Now, if you look at the survey data, you've seen a big deterioration in the first quarter, and that accelerated in April. And there's really two main consumer sentiment surveys, the University of Michigan survey and the Conference Board's Consumer Confidence Survey. When you look at the Conference Board survey, it had dropped 18.9 points from the November highs through March. And then in April, you saw another 7.9 point decline. So we're basically back at the 2020 pandemic lows. And when you see deteriorations like this, they only occur during recession. So the degree for which this softer survey data will translate to actual hard data is going to be really critical for the economy going forward. And there are some signs that there is some cooling out there. Labor income obviously is the most important dynamic for the consumption backdrop because people spend what they make. And there are some anecdotes of consumers retrenching. Chipotle CEO Scott Boatwright said on the first earnings call that saving money because of concerns around the economy was the overwhelming reason consumers were reducing the frequency of restaurant visits. So there's more for this story to be told. Will the soft data lead to weaker hard data? We're not sure. It didn't materialize in 2022, but I think as we talked about earlier, it comes back to the labor market. The labor market can hold in there. We think that a recession can be avoided and a soft landing will be the outcome.
In the past, large drops in consumer confidence have led to a recession. What has that meant for U.S. equities?
Well, believe it or not, it's really good for U.S. equities, not the recession itself, but when confidence bottoms out. So we talked about the Conference Board's consumer confidence survey in the previous question. I want to talk a little bit about the University of Michigan's consumer sentiment survey. Now, for the final release for April, this came in at 52.2, which is near an all-time low. And this is a survey that goes back to the early 1970s. So we have over 50 years worth of data. But when you looked at the 11 major low points of consumer sentiment with this survey going back to the early 1970s, if you had bought the S&P 500 at the lows of sentiment, your forward 12-month return on average has been 25%. So just like when everybody's bearish, it's a good time to be bullish when you think about investor sentiment. The same thing can be said with consumer confidence. And if this is a trough level of consumer confidence, history would suggest that you're going to have more positive market returns as we look towards the end part of this year.
April 2025 was quite a volatile month for the S&P 500 index as it almost hit bear market territory. But Jeff, even though we've seen a recovery, do you have any historical insight to help us think about an equity market drawdown of this magnitude?
Well, it's often said that March comes in like a lion and out like a lamb. That reference goes to the transition from winter to spring weather, but it may be more applicable to what markets experienced in April. The S&P 500 fell in the week following the president's Liberation Day tariff announcements by 11%, and equities were at the precipice of a bear market. The drawdown was negative 19% from the February 19 peak, but stocks rallied in the back half of the month when we started to get signs of tariff de-escalation. And believe it or not, the S&P 500 was down just 0.8% for the month of April. So I think it's really important that you be flexible on what can happen as things are occurring over the course of the next couple of quarters. And, this is a man-made disaster, and all it takes is a positive tariff announcement or a change in policy to really change the perception of where the economy and earnings are going to go for the S&P 500. But you mentioned historical context. One thing that we've been advocating to our clients is the fact that we hit a correction in the S&P 500 is usually a good time to put money to work. And a correction is a negative 10% drawdown. We've had 34 of them since 1950, and we've had no recession. 6 and 12 months later, you bought the day that you hit correction territory, you had a positive 9.2% and 13.9% return, respectively. But what may be more surprising to a lot of the listeners is that if you had a recession, your forward 6 and 12-month returns were actually still positive. They were lower at 2.8% on the 6-month time frame and 1.2% on a 12-month time frame, but they were still positive. And a lot of people think that when you have a recession, it needs to be a big drawdown, like in 08, where it was a 57% drawdown for the S&P 500, or 01, 49% drawdown. But a lot of recessions really are much more muted from a market perspective. In 1980, you only had a 17% drawdown for the S&P 500. 1990, that number was 20%. 1982 is 27%. And the fact that we already saw a 19% drawdown in the S&P 500 means that we've already reached the levels that were seen in the 1980 and 1990 drawdown. So things are going to be choppy as we look forward. There is going to be some twists and turns. You're going to start to see the economy slow. You may have a little bit of an air pocket because of the pull forward, because of tariffs. And we would just say that regardless of economic outcome, the economy is on a pretty solid foundation right now, and there's not a lot of structural excesses. The consumer's in good shape. Bank balance sheets are in good shape. There's no real obvious bubble that's out there. And if we do have a recession, it's going to be pretty mild. And the associated sell-off, in our view, would be similar to what you saw in 1980, 1990, or 1982. So we're just advocating as we move through a period of choppiness that you dollar cost average into this, regardless of what ends up happening with the economy.
Okay, so given that insight and given what you just said about dollar cost averaging into opportunity, where do you see opportunity in U.S. equities on a go-forward basis?
We think active managers in the large cap space have a pretty good advantage versus passive indices. Active managers in the large cap core, 58% of them are beating the S&P 500 year to date. This is the second highest reading since the COVID-19 pandemic and ranks third overall going back to 2007. So this is really a dynamic where the Magnificent Seven, when it lags the market, is a nice tailwind to active outperformance. And right now, the top 10 names in the S&P 500, they make up about 35% of the index. And when the top 10 names make up 24% or greater, so well below that threshold where we're currently at, your average returns of the equally weighted S&P 500 or the average stock compared to the cap weighted index. So what does the average stock do versus the index? The average stock has outperformed by 6% per year over the next 5 years on average. So active managers that can sidestep some of that market concentration have a competitive advantage versus passive indices that can't. And a great analogy is to look at the last time you had a lot of market concentration, which was March of 2000. And you look at the top 10 names at that point, fast forward to today, so 25 years later, only Microsoft and Walmart are outperforming the S&P 500. All the other 8 underperform the S&P 500, and 5 of the names actually have negative returns, absolute returns, over the last 25 years. So, we see this dynamic playing out over a multi-year time horizon, and we think active managers really have a competitive advantage in this environment. And by no means do I think that this is the bursting of the dot-com bubble, but I think that's good reference for the last time that we saw elevated market concentration. And then the other area that I think there is an opportunity is for dividend growers. These are companies that have proven track records, high degree of earnings visibility. These companies have strong balance sheets, moats around their businesses. They do really well when markets are choppy. And they also have a fundamental reason that they can outperform going forward as well. Recently, dividend growers closed one of the largest 12-month performance gaps in the last 30 years relative to the S&P 500. And when you've had following similar periods of underperformance, like the late 1990s and the early 2020s, dividend growers went on to outperform the S&P 500 in the subsequent years. So I think that this is a really good asset class to look at if you want to have exposure to the equity markets, but want to have some downside protection if you see some choppiness and potentially a shallow recession emerge.
Okay, that's great. So active management with large cap core and dividend growers. Jeff, at this point, we're moving to the close of our conversation this afternoon. Do you have any closing thoughts for our listeners?
A lot of things are fluid right now. Given where the market has moved following the lows in April, and we had that round trip, the risk reward facing the economy and the markets is skewed slightly to the downside at the moment. But all it takes is a positive change in trade policy or a renewed focus from the administration on its supply side agenda, like deregulation, tax cuts, and fiscal support, which could really start to shift that skew in a more favorable dynamic. And we've obviously seen that happen here recently. But the key takeaway here is that prompt action is needed to counteract the negative and building effects of elevated uncertainty and those margin pressures that we talked about earlier. But there is a lot of movement in the trade area. It appears that China and the US are going to be starting some tariff talks in the next couple of weeks to months. You could get some memorandums of understanding that are known as MOUs with trading partners that create space for extended pauses on those reciprocal tariffs. And you could start to see some of these sectorial tariffs have some carve-outs. And you saw this with auto parts last week. So if tariff rates are coming down, we start to get some tariff deals into trade deals into place. A lot more certainty comes into the equation. And with fiscal stimulus likely coming in the back half of the year, we could see some choppiness, but ultimately we think that the market will move higher. So the key is that the economy was on a solid foundation coming into this tariff uncertainty. The quicker that this uncertainty is lifted, I think the higher that the markets can go. But I think it's going to take a couple of months to be able to work through this. And ultimately, we think should you see higher volatility and potential downward pressure in the markets, it's a dollar cost average into that, even in a shallow recessionary environment.
Jeff, thank you for your time and your terrific insight this afternoon. To all of our listeners, thank you for spending your valuable time with us for today's update. If you'd like to hear more Talking Markets with Franklin Templeton, please visit our archive of previous episodes and subscribe on Apple Podcasts, Google Podcasts, Spotify, or any other major podcast provider.
This material reflects the analysis and opinions of the speakers as of May 5th, 2025, and may differ from the opinions of portfolio managers, investment teams, or platforms at Franklin Templeton. It is intended to be of general interest only and should not be construed as individual investment advice or a recommendation or solicitation to buy, sell, or hold any security or to adopt any investment strategy. It does not constitute legal or tax advice. The views expressed are those of the speakers, and the comments, opinions, and analyses are rendered as of the date of this podcast and may change without notice. The information provided in this material is not intended as a complete analysis of every material fact regarding any country, region, market, industry, security, or strategy. Statements of fact are from sources considered reliable, but no representation or warranty is made as to their completeness or accuracy. What are the risks? All investments involve risks, including possible loss of principal. The value of investments can go down as well as up, and investors may not get back the full amount invested. Equity securities are subject to price fluctuation and possible loss of principal. Small and mid-cap stocks involve greater risks and volatility than large-cap stocks. Fixed income securities involve interest rate, credit, inflation, and reinvestment risks and possible loss of principal. As interest rates rise, the value of fixed income securities falls. International investments are subject to special risks, including currency fluctuations and social, economical, and political uncertainties, which could increase volatility. These risks are magnified in emerging markets. Treasuries, if held to maturity, offer a fixed rate of return and fixed principal value. Their interest payments and principal are guaranteed. Active management does not ensure gains or protect against market declines. There is no assurance that any estimate, forecast, or projection will be realized. Investors cannot invest directly in an index, and unmanaged index returns do not reflect any fees, expenses, or sales charges. Past performance does not guarantee future results. Any companies and/or case studies referenced herein are used solely for illustrative purposes. Any investment may or may not be currently held by any portfolio advised by Franklin Templeton. The information provided is not a recommendation or individual investment advice for any particular security, strategy, or investment product and is not an indication of the trading intent of any Franklin Templeton managed portfolio. Data from third-party sources may have been used in the preparation of this material, and Franklin Templeton, FT, has not independently verified, validated, or audited such data. FT accepts no liability whatsoever for any loss arising from use of this information, and reliance upon the comments, opinions, and analyses in the material is at the sole discretion of the user. Products, services, and information may not be available in all jurisdictions and are offered outside the U.S. by other FT affiliates and/or their distributors, as local laws and regulation permits. Please consult your own financial professional or Franklin Templeton institutional contact for further information on availability of products and services in your jurisdiction. Issued in the U.S. by Franklin Templeton, 1 Franklin Parkway, San Mateo, California, 94403-1906, 800-DIAL-BEN, 342-5236, franklintempleton.com. Investments are not FDIC insured, may lose value, and are not bank guaranteed. Issued by Franklin Templeton outside of the U.S. Please visit www.franklinresources.com to be directed to your local Franklin Templeton website. Copyright 2025 Franklin Templeton. All rights reserved. Podcast theme music by Adam Vodofsky.